Welcome to Behind the Ticker, the podcast where we go beyond the symbol and into the strategy. I'm Brad Roth, founder and chief investment officer at Thor Funds, and in each episode, I sit down with ETF managers, CIOs, and industry leaders to break down how these funds are actually built, how they behave in real markets, and how advisors use them in real portfolios. Most people just see a ticker symbol, but we know much more goes on behind the ticker. Hey, David, welcome to the show.
Thanks for having me. It's great to be here.
So before we get started, why don't you take just a little bit of time, tell everybody a bit about your background, how you went from trading REITs at Green Street Advisors for over a decade to now being the CIO over at Hoya Capital.
You know, it's funny because REITs are such a niche type industry. When I was growing up, I grew up learning about Warren Buffett at a very, very young age. My father put the Wall Street Journal in front of me when I was like 6 years old. And I was fascinated by the stock tables, and, they don't publish stock tables anymore. And so I always knew I wanted to be on Wall Street in some form or fashion. And when I landed my opportunity at Green Street, I'll never forget my boss told me on the day I started, which happened to be when the NASDAQ crashed in March of 2000. She said to me, kids your age don't get the opportunity that you're being given today. And it, looking back on it, kind of offended me, but I'd also realized how right she was. Because again, Dallas, Texas, you don't think of REIT trading desks and then, huge Wall Street opportunities like a New York mindset. And I was there for a long time. I got to watch the REIT industry grow up. All these new companies come public, all these new investors come into the fold, all these new sectors that came out. It was just a very different landscape than what we saw today. After Green Street went toward what I call a New York trader's philosophy, where it was sales traders, head trader executing trades, and I lost the ability to basically push the buttons, which is what I always wanted to do. I was let go, and I landed in Dallas with a firm at the time that was very well known in creation and seeding of ETFs, rebalancing and trading, and a lot of folks may know the firm. It was called Esposito Securities. When I was at Esposito for several years, almost like my time at Green Street, I got to watch the ETF industry grow up. So many new issuers come out, so many new thematic type funds that came to the market. And to really be sitting, in the action, working with a lot of these new issuers that at the time, weren't well known, that today are household names in the industry. It was a fascinating business at the time, and I really learned a lot. Got into a disagreement with the boss man and then gave my resignation in 2018. COVID hits, and I was working with a broker dealer doing a lot of illiquid securities, REITs, closed-end funds, MLPs, BDCs, preferred stocks, new issues, just stuff that not your typical trader would want to handle. And during COVID, I got a phone call, and it was talking to the team saying, hey, you're really well connected in the world of REITs. We're looking to launch a REIT ETF. Would you like to be involved in this? And it wound up, launching a very thematic residential REIT ETF, which led to a second fund that was kind of like a private REIT spinoff, made up of publicly traded REITs. This was back when the non-traded REITs were gaining redemptions and investors couldn't get out. We were trying to provide a wrapper to allow investors to get into that. I rang the closing bell on the NASDAQ in July of 23 to celebrate the launch of that ETF, and was let go a week later. And in that time that I was on the beach for a couple of weeks, I was doing consulting for a little bit for another REIT, and I got to ring the closing bell in the New York Stock Exchange on the podium within a couple of weeks of the NASDAQ, which was kind of a cool experience. But a buddy of mine called me up and he's like, hey, I love what you do. You're so active on social. You're such a great storyteller. Why don't you keep doing that, but come do it for me? And, it really didn't take much twisting of my arm. When I joined up with Hoya in September of 23, we had around $75 million under management. Here we are, fast forward a couple of years later, we're around over 135, 140-ish million dollars across our two funds. And it's great. It's still doing all the fun things that I've gotten to do my whole career.
It's great. I mean, before we get into Hoya and the products, the REIT products, I always like to ask people, and it's funny, you and I were talking about football before we hit the record button. What do you like to do for fun when you're not sitting behind the desk and, I guess looking at real estate markets all day?
Well, if anybody who knows me in this business will tell you, I am a very, very big fan of the rock band Fish. I just got back from Mexico, seeing them there last week. I'm close to seeing 250 shows, and I'm hoping I can get to another 100 shows before they retire.
Awesome. That is dedication.
Well, living in Dallas, Texas versus on the East Coast, which is their home base, it's a lot of travel and I love doing it. It's funny, it goes back to my time at Esposito when I was working some very long hours and I would miss shows that I would want to go see. And when I left, I kind of had this epiphany, and it's part of a bigger story, but I had this epiphany that life's too short. You got to enjoy these moments while they last because we're only here for that amount of time that nobody's going to tell me when and where I can go see a show, what I can do, what I can't do. As far as I'm concerned, the only person that can tell me that is the boss, also known as my wife. But even then, she knows that if I'm not at Fish or if I'm not at my summer camp in Wisconsin with my group of friends, chances are that there's something else going on, or I'm sitting here at the desk focused on REITs.
That's great. So let's talk about Hoya Capital. Kind of like it. Do you kind of know the origin story, how the firm came together, and really what was the gap that Hoya kind of saw in the market that made you guys and the founders say, look, we need to build this thing?
That's a great question. Hoya goes back over a decade now. My partner was a Georgetown alum, took a real estate class, met the professor, built a really good relationship, wrote his graduation thesis on the REIT industry. And because he really grew up in college learning about REITs, he started writing research and he started a platform on what's known as Seeking Alpha, covering the REITs and the real estate companies and the home builders. And at the time, there was only a handful, literally less than a handful of writers covering REITs on Seeking Alpha. So through a steady stream, again, as I was growing up in this industry, just like he was, a steady stream of constant research, putting products that are out there, sector level, company level, his quality of research really started to grow up. More importantly, it was the visual approach, the charts, the graphs, the stories that jump out off that page. He was able to kind of build this niche that really was infant stages of Seeking Alpha, again, a decade ago. So through that, as he built up a subscriber base, a follower base, they reached out to him and said, hey, this is great. Why don't you start launching some ETFs? And this is right when COVID was happening that he launched the first housing ETF, HOMZ, did very well during COVID, gave it back after COVID. And then through that launch, through that first year or two, the clients were like, wow, this is great. But what about something with more income? And that led to this growth of the birth of the second fund, RIET, which we'll talk about. And that's really kind of how to fully play the REIT sector. But it's funny because I tell him he's better behind the screen than in front of the screen. You sit there, write the research, cover the companies, let's put the stuff that's out there and educate. And then we can figure out how to make up the wrap or how to tell the story and get it in front of the masses.
Yeah. So you mentioned you had two flagship products, REIT and HOMZ. Again, great ticker symbols. Two shows in a row where the tickers are they're great. Last week I had mood on, it was a sediment indicator. So, I mean, these are perfect. If you and I are, at a cocktail party at a conference or, just hanging out and I guess watching football, how would you explain the difference between these two products at a very high level?
Such a great question, and I focus on this every single day. It's a growth versus income story. Homes plays into the call it topsy-turvy supply demand imbalance that we see in the housing markets. At the time, there wasn't a true one wrapper fits all way to play the housing story. So this covers home builders, the residential REITs, the service providers, the brokers, the agents, and the retailers, your Home Depots, your Lowe's. It's one whole wrapper talking about the world of housing. REIT is completely different. REIT focuses on income. What REITs pay the highest dividends with, frankly, the lowest leverage ratios? Where are the opportunities that are in the sector that aren't in the top 10 holdings of every single REIT ETF that's out there? For us, we see that value, frankly, in four different places: the small caps, the mid caps, the mortgage REITs, and the REIT preferred stocks. So, because of the unique focus of basically going, instead of it being VNQ, kind of going QNV upside down, we're weighting it really more towards, again, the small and mids, the mortgage REITs, the preferreds, and we pay a monthly dividend that's currently annualized over 10%.
So, as part of that selection process, when I was kind of looking at everything, there's a multi-factor selection process. Can you kind of break down how you're screening specifically in REIT, the ETF, just beyond income or dividend? Like, what is that screen really looking for?
It's a great question. There's definitely like a quality score type of ranking that goes into it when you look at management, history, operations, communication, transparency, all these different things that kind of make up the whole thing. But frankly, it's also capping weightings. It's de minimis exposure to the large caps, X amount of exposure to mid caps. How are we weighting it on a geographic basis? What about a sector by sector or subsector by subsector basis? We really try to provide, I would really call it a truly diversified basket of REITs so that we're not overweighting or favoring one sector over another, but kind of having the yield play into that story. It's obviously hard to say that, this company is cutting their dividend next week, next month, next year. I wish we all had that crystal ball, obviously. But when we cap our weightings, our goal is, and when I say cap, I mean like the biggest exposure is around 1.5% of a weighting. So, and our hope is the majority of the REITs would raise the dividends throughout the year that would offset that company cutting their dividend. One other unique way, I'm correct me if I'm wrong. I still think we're the only REIT ETF that's on the market that combines both common and preferred stocks. So we have a 10% weighting, or one third of the 100 names in our portfolio that are liquid REIT preferred stocks. The REIT preferred market is a whole different animal in itself. And so the key is they have to be liquid, because they have, some of those have very wide spreads that you can lose that percent, 2% very quickly. But that exposure to the preferreds adds a couple of percent of yield to the bottom line. So I had this conversation yesterday. Our focus really kind of plays like the NCAA basketball tournament, last in, first out type of situation. So really for us, it's the question of the 5 to 10 names of the top or bottom range of going in, cutting off. Which are those that we really need to look at closely? Because again, the guys that are towards that top of that portfolio aren't going anywhere, but it's the ones that may be going through some issues. How do we replace it effectively to cover, again, the geography, the sector, the yield, the story?
As you mentioned, Homes, HOMZ, takes a different approach. It's tracking the US housing market more broadly. And it's interesting to me when you have housing as a third of consumer spending, but is very underrepresented by first of all, why do you think that is? And why hasn't anybody really tried to tackle this other than, this type of exposure that you guys are offering through Homes?
I think it's a good question because it's kind of dominated by like home construction, or like the home builders index, IHB. Pick your favorite housing fund. There's a couple of them have like what I call different rubs to them. Like Res is another very well known ETF, but that covers like storage and residential. I think I think there's a couple of different things. Number one, it's a boring story. It's dominated by a handful of major home builders or home retailers. It's not really something that people focus on. But the problem is, or where we see the excitement is the opportunity. There's simply not enough affordable homes out there for the amount of demand that we're seeing. People are like, well, I want to live in Dallas, Texas, but I can't affordably live in Dallas, Texas. And I'm like, that's not true. If this is Dallas, you're just going to live out here. It's the same thing like in New York. You can't live in New York City. You're going to live a train ride away. And as I'd like to say, until we see the home builders deliver a light-ish product, instead of a $500,000 delivery, it's a $300,000 delivery. Until we see manufactured housing becoming more respected and well known, that's not trailer park trash that had that old reputation, let's say, let's see how that grows. Remember, you can buy a manufactured house on Amazon. Did you know that? That's kind of crazy if you think about it. We can buy anything on Amazon, actually.
I actually do know that because I was looking at one of those to put in my backyard as a shed. I'm like, I can get a mini house on Amazon. How are they going to deliver it? How am I going to put this thing together? But they're there.
And I think one other angle, again, talking about home affordability, that's why we've seen the growth of single family rental players that are out there, both on the REITs and the private side. We've seen obviously the headlines from the administration, and we think that's going to be actually good for the REIT industry because REITs aren't institutional investors just necessarily. So I think it's because it's a sector that's always in the crosshairs, Fannie, Freddie, the government, the local level, uh, um, the number of apartments versus the number of homes, all these different stories. It's just kind of a complicated sector. But it could, again, very be summed up of until we deliver another 5 to 6 million homes that's out there, the rental-ish players are always going to be in demand. And in fact, more importantly, I think you're going to see more of this rent to own type story come into play where you live in a property for 5 years, you've earned up enough money to pay for that down payment and take over the note from that landlord, and then you're responsible for paying the mortgage over the next 30 years or something.
So when I hear, the word REIT, I always assimilate it with, high yield, and interest rate sensitivity is always the big question with REITs. How do you guys over at Hoya think about duration risk? How are you looking at the current environment to kind of, uh, you know, make these not as, I would say, rate sensitive and kind of combat that feedback that you get from most, advisors or investors?
These are great questions. Um, First of all, when you think about REITs, if they're interest rate sensitive, I kind of take a pause because look, we're using a REIT right now to have this conversation. Did you think about where interest rates were before you hit the record button we got on this Zoom today? No, of course not. We use REIT owned properties every single day of our lives, not thinking about where the 10-year Treasury or the Fed funds interest rate is at. That's number one. Number two, I think it's tied more to the 10-year Treasury than it is to interest rates necessarily. Because when I think of REITs, I think of dividends. The average REIT dividend yield's around 4% or four and change right now and kind of increasing. The 10-year Treasury right at this moment in our conversation is at 4.212. I like to say that 4% is the magic number. If the 10-year goes below 4, that benefits REITs. As it's above 4, REITs are kind of out of favor, looking at REITs versus fixed income. So that's a stigma. But before the call, we were talking about our respective football teams, and I ran off a stat with you about Mike Tomlin, who just recently left the Steelers, that going back to 2007, over 130 REITs had basically gone away and 110 plus REITs had come public. In the past quarter or 4 months or so, 17 different REITs have merged or basically figured out strategic alternatives. It's a momentum-ish type of sector that when people start getting on, they get on hard. And when they get off the train, they get off in mass. But it's also like M&A. When one guy starts an M&A transaction, next thing you know, 10 other companies are in play. And the reason being, if you're a private equity guy, it's cheaper for me to go out and buy an existing platform of 100 properties than me to go out and build 100 properties in today's environment. The opportunity is that a lot of these REITs are trading at discounts to their net asset value, meaning a perfect example of this is a Cohen and Steers, which is a very well-known real estate investor, just did an interview in Barron's this week. They picked two very well-known names, Digital Realty and Welltower. But the third one got me excited because I used it in all my conversations. And the company was Empire State Realty Trust. They own the Empire State Building. Did you know that you can buy the Empire State Building for $6.50 a share right now? Empire State is trading at $6.50. Now, I'm not an analyst that has a model in front of me, and I can't use the word guarantee and all that stuff. But wouldn't you think the Empire State Building is worth more than $6 a share, the most famous office building in the world? So if somebody is able to buy all of these great properties at $10 a share, $11 a share, whatever it is, that's value. That's potential income. By the way, mentioning, say, REITs are a dividend story. When I think about REITs, anything that happens to the stock price is the extra cherry on top of the sundae. We focus on the income side of it. People neglect to remember that not all REITs are high yield, as you stated yourself. The top 10 REITs that make up most of the passive REIT ETFs that are out there, they're like 2% yield, 3% yield. So you're really not getting that much smash for the investment, is how I feel. Um, so let's say the most famous REIT that's out there is called Realty Income. The ticker is the letter O. They're known as the monthly dividend company. And they paid a monthly dividend for a long, long time. And person could be like, well, I only made 5% return on Realty Income on their stock price in the past couple of years. And I say, yeah, but you also forgot about the $2, $3 a share that they paid you in dividends in your pocket. You don't think about that. So that's why I like to say anything that happens with the stock price is an extra bonus. As investors who own REITs, you should focus on the income that they pay out to you. By the way, simple definition, a REIT is a tax structure. That's all it is. The laws of the tax structure dictate that the REIT passes all of that net income, the profits and stuff that they earn, back to the shareholder in the forms of dividends. So that's why the management teams own so much stock, because when they raise their dividend a penny over a year, that means their quarterly bonus just went up by a penny times X million number of shares. They want to see it do just as well as grandma and grandpa who live in the villages.
Yeah. So you publish the REIT Beat, which is again fantastic name.
Thank
You
you.
guys have understood marketing. What's one thing advisors just really get wrong about REITs in general? What you hear all the time. I probably already just said it. REIT equals high yield.
Said two of them. You said two of them. REITs are interest rate sensitive, and REITs, again, as you just said. Sorry, I got so excited I got sidetracked. REITs are. Here's how I phrase this. There's a lot of ETFs that are out there today, a lot of different thematic funds, a lot of sectors. Okay. So we're seeing a lot of volatility in crypto right now. And I'm not going to hammer on crypto. But if you go to any advisory firm and say, hey, what percentage of the pie is in crypto? You, there is no answer. But if you go and ask them what percentage of the portfolio is in REITs and real estate, every single guy has a number. Why? Because REITs are boring, and boring is good. That it's the ballast of the ship, it's the tortoise and the hare of your portfolio. If you want risk in the world of REITs, you go out and buy a hotel REIT because that's a one-night contract. The next step up is you go out and buy an apartment REIT because that's a 1-year contract. But an office lease is typically 5 to 10 years. The Starbucks lease at the shopping center, 5 to 10 years. Long-term leases that are in place with set rent bumps tied to CPI or set rent escalators, whatever it is. One more. There's a REIT out there that focuses on ground leases. They own the land on which the building above is in place. That lease term is 99 years. So if you own if your name is Vici Properties and you own the land on which the MGM Grand sits on, hypothetically, do you care about the day-to-day headlines that we see in the news? No. People talk about the death of office as an example. Office only represents 4 or 5% of the portfolio weightings these days across all these sectors, but they get 90% of the headline attention that's out there. So I just feel like REITs have this misconception that they're all high yielding. They're all interest rate sensitive. I disagree with that. There is quality out there in the small and mid cap space. There is quality out there, frankly, in the mortgage REIT space. And for me to say something like that, who grew up at Green Street, that was always, frankly, anti-mortgage REITs, they shunned on the sector, it kind of tells you how things have changed in the world over the years.
Super interesting. So for advisors who are listening and just listen to that, and they are now wanting to look at adding some real estate exposure to their portfolio, kind of what's the piece of advice you would give them? And like more importantly, how should they think about using your two ETFs in kind of that overall portfolio construction process?
This is great. This is a great question. I love talking about this in particular. If the advisor owns VNQ or IYR, which are the two most well-known REIT ETFs that are out there, others including FREL, SCHH, KBWI, the list goes on and on. First of all, the holdings are basically the exact same across all of those ETFs. We make a nice complement to those existing funds. I think we're the perfect hedge or companion to the VNQ or IYR fund. We also like to say that HOMZ and RIET together are a great complementary exposure to play real estate. But to answer your question, I go back to what Todd Rosenbluth used to say many years ago. And Todd always used to say, you need to lift up the hood of the car and check out the engine. What kind of engine is pushing that car down the road? And it's the same thing in these ETFs. You need to look beyond the top 10 holdings and see what's out there. You know, it's funny. I saw an article today that was talking about one of those big funds that's out there. And they said, did you know that these top three names represent 23% weighting of the portfolio? In the world of REITs, to have three names representing almost a quarter of the weight, that's a lot of exposure to it on something that isn't paying a lot of yield. So that's why I think it's important to lift up the hood of the car, because there's great sectors, there's great subsectors. There's like every other sector that's on Wall Street, there's a couple of bad apples. When I talk about the world of REITs, I always use the same analogy. The world of REITs is like your graduating class of high school. You have the valedictorian, the salutatorian, the REITs in the S&P 500, the dividend champions. You have the REITs in the bottom 10%, the bullies, the troublemakers, the kids in detention, the over-levered REITs, the guys that cut their dividend. It's the middle part of the curve, the students that didn't get in trouble, that nobody knew who they were, just like this 150 of these REITs that make up the middle part of the curve, that people don't know what it is that they do. And there's great stories that are out there that people don't realize. I was just at that property yesterday, and that's a REIT. I had no idea. That's what we get excited about, is educating these great stories that are out there that people don't realize actually are REITs.
It's great. So I want to just kind of like switch gears here for a little bit and ask a philosophical question. You've seen the ETF game now for quite some time. What do you think the hardest part is about being an ETF issuer that no one really?
Oh, wow. Wow. You didn't prepare me for that. That's a great
No,
one.
it did not.
Love it. I think you get a great, you hit me on a different day, you probably get a different answer every single day. So that's number one. I think it's the fact that when I was growing up at Espo, we used to joke, all it took was a great ticker symbol. You have a great ticker, you're going to the moon. Doesn't matter what your name is, your performance, how much AUM, you have a great ticker. Now I think it's with a very saturated market, especially again in the world of REIT ETFs that are out there, you have to have something so unique and value compelling that stands out from the herd. And I don't know how many of those opportunities exist. I want to give credit, a good example is a guy named Kevin Kelly, who several years ago launched with Pacer, INDS, SRVR, a couple of these REIT thematic ETFs when it didn't exist back then. First mover advantage. That's, again, a Warren Buffett philosophy. The fact that they were thinking so far ahead, I salute those guys for doing it. So there's some great stories that are out there that just never get the focus on because, again, people just say, I own VNQ. Set it and forget it. I don't have to worry about it. Whereas with good management, guys that understand the sector can find the alpha and the good stories that are out there that don't get the time or attention. I think that's kind of why my last venture didn't work out so well, because when you only have $5 or $10 million under management, it's very difficult to get a voice in front of that advisor when Vanguard, who has 3 basis points to go out and buy VNQ or whatever it is going to win that trade 95 times out of 100. That's the hardest part, I think, for the ETF guys, is when you're small, it doesn't matter how good your team is, how great your research is, what kind of performance numbers you're putting up. It's how much money do you have? What's your expense ratio? and not really looking at the story.
Couldn't agree more, David. And I can't tell you how much I enjoyed this conversation and you spending some time with me today. Before I let you go there, where can people learn more about Hoya Capital? Where can they learn about your ETFs? Where can they subscribe and get your daily REIT beat?
I thought you were going to ask me where can they find me at the next Fish concert, but no, in all seriousness, HoyaCapital.com is our research platform. Hoya ETFs will walk you to our RIET and HOMZ fact sheet, the daily REIT beat, free to sign up, free to subscribe. I don't charge for it. Again, it's my baby, the daily REIT, REITbeat.com. You can find me on LinkedIn. I also have a REIT TV channel if you want to watch it on the visual side, REITTV.com. I represent the REIT industry. I highlight the good, the bad, the ugly, but the key is to highlight the sector. My job is to focus on the whys you should be investing in the sector. Hey, to anybody that's watching this, if you like the story of our ETFs, that's great. Happy to talk more. And if our ETFs are not for you, that's okay as well. Reach out to us so we can help you find that good REIT ETF that excites you, or frankly, the good individual company that's out there. Let us help make those intros to those management teams. We represent the industry so that all of your clients and investors can have that income exposure that they should have in their portfolios.
Thanks so much for being with me today.
Thanks, Brad. I appreciate it.